Q4 and Q1 are strong for crypto in general. It all really depends on the dollar. The dollar's the massive swing factor here because central banks, although they're cutting in terms of interest rates, which is liquidity positive, but really only at the margin. It doesn't make a massive difference to asset prices. It does to the business cycle, which has a knock-on effect for capital expenditure and consumer spending. So generally all very, very positive. But without central banks actually expanding their balance sheets, then really what happens with the dollar is the most important thing right now to
You've probably heard people say the fourth quarter is when Bitcoin wakes up. Jamie Coutts, a crypto macro analyst, says there's some truth to that. Q4 tends to be one of the strongest periods for Bitcoin and the broader crypto market, with that momentum often spilling into the first quarter of the next year. But he's quick to add seasonality isn't a rulebook. It's more like a pattern that often repeats, not a guarantee. Here's what really matters right now: the US dollar. Coutts says its movement has become the single biggest force driving risk assets like crypto. When the dollar strengthens, crypto struggles. When it weakens, liquidity flows back in and prices respond fast. Rate cuts, he says, help on the surface. They can push the ISM manufacturing index above 50 again, signaling growth instead of contraction. But cuts alone don't drive markets the way they used to. What moves assets is balance sheet expansion when central banks start printing or easing. Historically, major crypto rallies have lined up with those moments, not just lower interest rates. That's why Coutts believes the real turning point for crypto will come when the Fed ends quantitative tightening and starts easing again. It might even take a new Fed chair to make that happen. Until then, Washington still has options like tweaking the supplemental leverage ratio for banks. That one adjustment would let banks lend more freely, expand the money supply, and quietly pump liquidity back into the system. And liquidity, as always, is what fuels bull markets. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Generally, Q4 is seasonally a good period for Bitcoin and crypto. But like seasonality, those seasonality charts are pretty sort of dicey as well in terms of just like trying to look at them as sort of some sort of guide. But generally Q4 and Q1 are strong for crypto in general. It all really depends on the dollar. The dollar's the massive swing factor here because central banks, although they're cutting in terms of interest rates, which is liquidity positive, but really only at the margin. It doesn't make a massive difference to asset prices. It does to the business cycle, which has a knock-on effect for capital expenditure and consumer spending. So generally all very, very positive. But without central banks actually expanding their balance sheets, then really what happens with the dollar is the most important thing right now to track. So I just constantly look at what the DXY is doing. The DXY had one of the largest declines in Q1, Q2, and really into Q3 in decades. And that's the reason why I think even on, the last time I was on the show, John, was one of the main reasons I published like the bullish Trinity report, at the start of April saying, I think risk assets and crypto are going to go up a lot because of that. The speed of that decline was so significant. Now we're seeing the DXY sort of hold around sort of 90, 98, 99. It really matters. The next leg of that move, whether it's a retest of 101 or a breakdown below, will, I think, be incredibly important for risk assets. My view is that we'll probably test around 100. And so it might be a couple more weeks of chop. But eventually with interest rate cuts and what Trump is trying to do with best interest to try and bring the dollar down, that there is another leg lower. And so at some stage in Q4, maybe in November, we'll start to see crypto start to really catch a bid again. But, there's probably some assets that are worth buying right now with a view to the next sort of 6 months being particularly good. I think it's important for financial conditions in the business cycle. So cuts will, supercharge the ISM and bring it back above 50 and sort of, I think, continue or accelerate the improvement on that end. But I don't think it's as important for like just asset prices in general. I think asset prices respond to more of the quantitative policies from central banks. And at the moment, even though it's marginal, the Federal Reserve is still tightening its balance sheet. They're still conducting QT. So I don't expect them to change. Like we don't have a federal a Fed chief that's, I think, going to, while he's in charge, retire that policy. It's coming to an end at some point. So, whether it's with the new Fed chair next year, if you just look at the way central bank balance sheets have always clipped major turning points in crypto, I think that's more important than interest rate cuts. But that's not to say that they're not important, because the business cycle needs interest rate cuts. Interest rates are too high relative to the economic growth. They need to bring that down. They want to bring that down, interest rates down, so that they can unlock equity in people's primary asset, and sort of spur economic growth through the property market. So all of these things are definitely positive for crypto, but it's not the good old days of the 2010s where it was QE2, 3, QE infinity, and everything just responded on a dime to those quantitative measures. But I think those policies get retired, and also there's probably another trick up their sleeve with adjusting, like the government adjusting the SLR, the supplemental leverage ratio for banks, so they can increase liquidity into the market through more lending. So that would be, that would directly flow into M2.
Jamie Coutts says the crypto economy is moving money at a pace the traditional system can't match. In fiat economies, money velocity has been falling for decades. Capital just piles up in property and passive investments instead of circulating through real businesses. Crypto, on the other hand, is showing what fast, efficient value transfer looks like. The so-called Degans are effectively stress testing a new financial system where money actually moves. In just the last 5 years, blockchain networks have settled almost as much value as Visa, MasterCard, and PayPal combined, and they're expanding 7 to 8 times faster. If that growth keeps up, Coutts says crypto could overtake traditional payment systems within a few short years. That shift isn't lost on the incumbents. Major players like Visa and PayPal are already testing blockchain-based settlement systems, which could push adoption into real-world commerce instead of just trading and speculation. The big takeaway, Coutts says, is that base layer blockchains, or L1s, are evolving into true financial infrastructure. Their native tokens aren't just speculative assets anymore, they're becoming essential tools for global settlement. If the current pace holds, crypto's payment rails may soon rival and eventually surpass the legacy financial system. Let's get back to the interview.
Yeah, so I hadn't done this analysis really since 2022, and the data providers are getting a lot better with capturing settlement volumes. And settlement volumes in the crypto context means they are tracking settlement flows which are related to peer-to-peer transfers of the native token on an L1, transfers of any other tokens related to that L1. So on Ethereum, it's ERC20, and on Binance, it's their token protocol. So it basically assets moving on chain, but also peer-to-peer transfers of stablecoins and DEX volumes. There's also NFTs, but NFT volumes are really sort of negligible at this point. So you put them all together and you come up with like total settlement volume. The problem at the moment with this data is that even though the data providers are sort of are scaling it up, when you look across chains outside of Ethereum and Solana, you don't have all the data for all those different activity cohorts, but you get a pretty good proxy. So it probably undercounts. Well, it definitely undercounts total settlement volumes, but most of the volume is actually quite concentrated in Ethereum and Solana and also Tron. And there the data is a lot more comprehensive. So you've got a pretty good proxy. Now, the biggest drivers are DEX volumes, actually, which are, on Ethereum and also on Solana, account for a large portion of fees. So you could argue, hey, it's just speculative activity. It's degens doing degen stuff. The reason why I did this analysis is that I think it's so important for everyone who's investing in crypto or thinking about investing in crypto, is like, where will we be in the future? So the subjectivity that I experienced when I started working as a crypto research analyst at Bloomberg Intelligence, and you get the sort of sniggly remarks that, this kind of settlement volume is not the same as settlement volume on payment platforms like Visa and MasterCard and PayPal and whatnot. really, what was it showing initially? It was showing that the technology can scale, is far more efficient. The velocity of money that moves inside the crypto economy is magnitudes more than the fiat economy. What is the problem with the fiat economy? Velocity has been declining for decades upon decades, despite the Keynesian economics models and theories saying that they could tweak it through government policy and monetary policy. That has not happened, although we've seen a spike since COVID, but generally that trend has been down. Low or declining monetary velocity in any economy is not good. It shows that capital is not moving. It's not moving into productive use cases. It's not spurring activity and entrepreneurship. In fact, I would argue that the main reason, or one of the reasons that velocity is going down, is because that all new money, or most money, is flowing into investments, not into productive uses, not into the real economy. In Australia, the banks won't give you a small business loan. They'd rather lend against your house in a property market that's trading on 16 times median earnings. So this is a huge problem. Meanwhile, this parallel system full of degens and libertarians is showing that they can move money, move immense amount of value, and that value that the crypto economy has moved in the last 5 years is almost as much as Visa, MasterCard, and PayPal, but it's growing at 7 to 8 times that in terms of annual growth rates. So within 2 years, it's going to overtake. What happens when Visa, MasterCard, PayPal, which they're already doing, start moving all of their value flows or the settlement volumes onto blockchains? So you get this exponential explosion again, and then the critics can't really argue that it's just degens anymore, because it's actually them paying for their coffee or paying for their Amazon gift card. So it was just really a way to sort of go back to basics. The analysis I was doing in 2022, I was looking at Bitcoin and Ethereum specifically. Now look at the entire layer ones and go, hey, these guys are growing at a clip, and now all the payment companies are going to actually integrate with them. And that drives the asset price. That drives the value of the L1 token. The L1 token is the settlement token of the chain. And even with new chains coming on that are stablecoin specific, everything is growing the pie. There's going to be winners and losers, but the pie is growing substantially. And we go from, 80 trillion, in 5 years. We do that in 1 year and 2 or 3 years' time.
Something deeper is happening beneath the price charts. What began as an experiment in digital money is quietly maturing into a functioning parallel economy, one built on code, not central banks. The old financial order moves slowly, weighed down by regulation and debt, while crypto keeps accelerating, processing real value at speeds traditional systems can't touch. Each cycle of volatility refines it further, weeding out speculation and leaving behind infrastructure that works. Whether regulators embrace or resist it, the direction feels set. Liquidity, innovation, and capital are migrating toward the networks that move fastest and settle instantly. The transition won't be smooth, but revolutions in money never are. As the digital rails of finance start to outpace the legacy ones, the real question is whether governments will adapt and integrate, or try to fight a system that's already rewriting the rules of global value exchange. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.